Supply and demand gets mentioned in basically every single trading video. But let's be honest, some traders draw them completely wrong, get stopped out, and then blame the strategy. Today, we are fixing that. We're going to cover exactly what supply and demand actually means, how to mark clean, high-probability zones instead of just guessing, and 2 specific ways to trade them. So, if you want to stop being the liquidity and start trading with the big players, hit the like button to support the channel, and subscribe if you are new here. Let's begin with the basics. Every single price move on your chart comes down to a simple tug of war between buyers and sellers. When demand outweighs supply, buyers are so aggressive they're willing to pay higher and higher prices just to get filled, so the price explodes upward. When supply outweighs demand, sellers are desperate and accept lower prices to get out, so the price plummets. That is the entire engine behind every single candle on your screen. If you've ever looked at a volume footprint chart, this becomes completely obvious. Heavy volume on the buy side means traders aggressively paid up to get in. Heavy volume on the sell side means they chase the market down to get out. Price doesn't move because of some magical geometric pattern. It moves because real orders were willing to aggressively chase a level. So, what are these zones actually doing? A demand zone marks a specific price range where buyers stepped in heavy and shoved the market up. A supply zone marks where sellers did the exact same thing in reverse. The thing is, markets have memory. When price returns to a valid demand zone, those same buyers often step back in. When price revisits a supply zone, sellers tend to defend it. In simple terms, demand acts like potential support, and supply acts like potential resistance. They give you high probability areas where price is likely to react, instead of just drifting randomly. But let's be real, not every pause on the chart counts. A few quiet, sleepy candles drifting sideways isn't supply or demand. That's just retail chop. What you are looking for is pure aggression, a violent push that shows a massive imbalance. To make it more clear, the 3-candle rule. You need to see at least 3 consecutive green candles with large, solid bodies and real distance traveled to validate a demand zone. You need 3 strong consecutive red candles to validate a supply zone. That is the hard line between a zone worth risking your money on and random noise you should completely ignore. Now, how do you actually draw the box zone? There are plenty of theories out there, but the only rule that matters is finding exactly where the move began, not the middle of it. The cleanest, most objective method is to highlight the last candle of the opposite color right before the explosive momentum started. That candle represents the last stand of the opposing pressure, the final bit of selling before the buyers took total control, or the final bit of buying before the sellers completely took over. You simply mark that entire candle's range from body high to body low as your zone. But the important part, if that opposite color candle has a massive, obvious wick, draw your zone strictly around that wick instead. A long wick shows a violent, instant price rejection, meaning the true institutional orders are sitting right inside that tail, which gives you a much tighter, more accurate zone. But the catch with any zone, the market doesn't owe you a perfect, accurate tap right on your line. Sometimes, price gets incredibly hot and reverses early. Other times, it cuts straight through the front of your zone to grab deeper orders before flying. To stop missing trades and stop getting hunted, you need 2 quick adjustments. To avoid getting left behind, place your limit entry a spread or 2 above the actual start of the demand zone. That way, a quick graze is enough to fill you. To avoid stop loss, hunts on tight ranges. Don't crowd a small zone. Give your stop some breathing room by hiding it safely behind the major structural swing low. If the zone is exceptionally large, don't buy the very top of it because it ruins your risk to reward. Instead, wait for price to retrace to the 50% midpoint of the large zone to enter and place your stop just below the box zone. Let's put this into a practice strategy. Strategy number 1 is the single time frame execution. It works on any chart, any market, and follows 3 steps. First, confirm the trend. Look for a clear 1, 2, 3 expansion followed by a clean break of structure. Once price breaks above the most recent swing high, you are in a confirmed uptrend. Each new breakout gives you a new protected structural low. As long as price holds above that low, the trend stays intact. But if price breaks and closes below that protected low, the uptrend is dead. That is a change of character. Buyers have lost total control. and you immediately flip your bias to look for fresh supply zones to short. Step 2. Map your zone using our rules. In an uptrend, mark the demand zone, place your limit at the front of it, and put your stop below that protected swing low for ultimate safety. Step 3. Before you hit execute, do a macro sanity check. Zoom out slightly and look at the path ahead. Does the price have clear room to run? If there is plenty of open space ahead, the trade makes complete sense. But if your buy entry sits right beneath a massive higher time frame resistance level, you are driving straight into a brick wall. Skip the trade and wait for a better alignment. If you want to take your precision to the highest level, strategy number 2 uses multi-timeframe confirmation. You find your zones on a higher time frame, then drop down to a lower time frame to trigger the entry. A great rule of thumb is that your execution time frame should be roughly a quarter of your analysis time frame. So, a 4-hour chart for your macro direction pairs perfectly with a 15-minute chart for your entry. Once you mark your high momentum zone on the 4-hour chart, turn off your hands and wait. Do not blindly buy the exact second price touches the box. Early retail buyers get swept away as liquidity all the time. Let the price fully commit and enter the zone. When it hits, drop down to the 15-minute chart and look for your trigger, the liquidity grab. On a demand zone, you want to see price dip right below a recent minor lower time frame low, trapping breakout sellers and hitting retail stops. But then the candle must instantly reject those lower prices and snap back up to close inside the previous range. On a supply zone, it's the exact mirror. Price spikes right above a recent minor lower time frame high, trapping breakout buyers and hitting retail stops resting above it, then instantly rejects and snaps back down to close inside the range. Either way, that lower time frame liquidity sweep is your ultimate confirmation that the big players are actively stepping in. To enter, look at that sweep candle. The moment it closes back inside the range, you enter in the direction of your higher time frame bias. Place your stop right past the sweep that just occurred and target the opposing higher time frame structural level. You are now perfectly aligned with the institutional momentum. At the end of the day, supply and demand zones aren't magical lines that automatically flip the market every single time they get grazed. They are simply areas where massive buying or selling already happened once, which makes them highly worth watching the second time around. Mark them objectively, have the discipline to wait for real confirmation instead of guessing, and manage your risk like every single trade is just one of 1,000. If this simplified breakdown actually made sense to you, drop a like, comment below on how you draw your zones, and I will see you in the next one.